Next, my second most important investing habit was not trying to time the market. This one is probably the simplest, most factual pieces of advice you will ever hear when it comes to investing, but it's also the most difficult to follow. That's because pretty much every investor out there thinks that they're smarter than everyone else, that this time is different, they'll read up on all the signs and charts that indicate future price action, and then they believe that they could outperform every other professional investor by timing their investments. But unless you get absolutely lucky or you work for Congress, you're probably not gonna make a lot of money doing this, or you're gonna lose. Don't just take my word for it either. Here are the facts to back this up. Since 2003, had you just bought and held, your annualized return would have been about 9.8%. But had you been trying to time the market and missed just the top 10 best trading days over that time frame, your annual return would drop all the way down to 5.6%. And all it takes is to miss the top 30 best trading days over 20 years, and all of a sudden your return drops to just 0.8%, or basically below the rate of inflation. There's also another study out there that shows that, generally speaking, the more trades you make and the more you try to time the market, the lower your overall return becomes. This is why it's proven that the average investor is absolutely horrible when it comes to investing, and they dramatically underperform the market. So in terms of what you could do about all of this, it's very simple.